Hello and good afternoon. Hopefully everybody can hear me okay. I see all the people that I was expecting to log in that were registered. I am going to share my screen in a second and we are going to jump into our presentation today. We have an exciting presentation I'm sure people are excited about, which is about HSAs, HRAs, FSAs. What do we do and what's going on here? So it's going to be a really informative training today. And I just need to make sure that my screens haven't swapped when I'm presenting, and then we will get right into it. So I am hopeful that everybody sees my presentation here. If you do not, please feel free to throw something in the chat function. Today's presentation is put on by BlueLion. We are presenting on HSA, HRA, FSA, what? It's going to be a fun interactive presentation informing you a little bit more about these plan designs, how they can help your insurance, and how we pair them accordingly and how we leverage them. This presentation will be recorded, which means I will follow up with the recording to everybody who has attended today and even those who haven't to make sure that they can get informed. We do provide a disclaimer. I am not giving legal or tax advice. I am giving information, education on these particular plans. If you do want to have questions, you can ask your benefit broker. You can reach out to us directly if we support you in that aspect. But our legal loves it when we have to put this stuff in there. This is my amazing team. We are an HR consulting company located in New England. I physically am located in Manchester, New Hampshire. And our purpose is to provide HR support to businesses. We specialize in blue collars and making sure everybody is compliant. We are real people with real personalities. We try and put a little bit more fun into HR than the fun police. And we do pledge 1% of our profit services and our time back to our community. So we are very, very big into giving back. My name is Toni. I will be your presenter today. I'm the co-founder and co-owner of BlueLion. I have had over 13 years experience of HR. I also have both my SHRM certification through the Society of Human Resource Management, and I also have my certification through the Human Resource Certificate Institute. They used to be together, and now they're separate. So that's a little bit about me. HSA, HRA, FSA. So what do the letters mean? How do they work, and how do we? What makes each one of these particular plans different? We're going to really dive into that. And the training, we're going to explain HSA stands for health savings accounts. HRAs generally stand for health reimbursement arrangements. I have sometimes heard people call them health reimbursement accounts. Flex spending accounts for FSA, and how we leverage these three plans specifically, pair them with our health insurance and decrease our health insurance costs over time. So benefits of healthcare accounts. So there are increasing costs, right, of healthcare year over year. We're seeing an increase anywhere between 7 to 27% of healthcare costs for an employer. That is huge increases year over year for both the employer and the employees. So having these plans allows you to have a few more selections inside of your arsenal when we're deciding what plans to offer. It keeps your business competitive because some of these plans, like a flex spending and health savings, allow pre-tax contributions, which means employees get to save money on their medical, their dental, vision expenses. It's cost effective to add these in. Usually there's two ways you can self-administer these plans depending on the time and energy that you have, if you have the resources internally, or you can outsource them. I want to make it clear, BlueLion does not service these plans. We are not a healthcare company that does third-party administration. We work with some fantastic organizations. So if it was something that you were interested in and you wanted some more information, at the end, I will have contact info. So if you're like, who could help me with an HRA or an HSA, we would be able to support you with giving you a recommendation to a phenomenal local company as well that can support you through that process. The plans benefit not just the employer, but also the employees. They're able to put pre-tax money aside to use for expenses that they're already going to be spending. So we'll talk about what that means. And it does offer that tax advantage. So the IRS allows both flexible spending accounts, health reimbursement accounts, and health savings accounts to be pre-taxed funds. So depending on how we pay them, we don't have to pay taxes, Social Security, Medicare, and federal income tax or state income tax, if anyone's on the call who is not a New Hampshire employee. If you're a Massachusetts employer, you get to waive the state income tax on that. So our first one, health savings account. I'm not going to lie, this is my favorite thing to talk about is health savings accounts because they are the most complicated, but they shouldn't be, but they're the most underutilized and shouldn't be. So it's kind of a double-edged sword here. So it's an individual savings account funded by pre-tax dollars. So you think to yourself, Toni, a savings account, what does that mean? Can I open it up at my bank? Possibly, maybe. But it depends. So in order to have a health savings account, you need to have a health insurance plan that is health savings correlated and accommodating. So a lot of what that means is it needs to have high deductibles. So it is a way for employees to pay for their healthcare expenses using pre-tax dollars. And HSA works, just like I said, as a savings account in which money is contributed. And those funds can then be used for out-of-pocket medical expenses that are not covered by the insurance plan. So there are lots of things that aren't covered by an insurance plan, right? Sometimes we have prescriptions, sometimes there's copays, there's co-insurance, and all of those little nitty-gritty things that are not covered like preventative care is. And that comes out of our pocket at the end of the day. That's why they call, the health insurance the deductible and the out-of-pocket max. This account is used in conjunction with those high deductible health plans. So sometimes they're referred to HDHPs, high deductible health plans. So this is the best for employees who do not have significant healthcare expenses or require regular treatment. And I'll explain what kind of people would maybe leverage this HSA account. A high deductible health plan, it does have a very clear definition through the IRS. It's a health plan that has a deductible. I know some people will laugh here, but a high deductible of $1,400 for individual or $2,800 for family minimum. Very rarely will you see those as the high deductible plans. We are usually seeing high deductible plans that are $4,000, $5,000, $6,000, $7,000 out of pocket. Currently, the IRS has maxed it that high deductible individual plans can't be above $7,050. So right now you won't see anything higher than that, but similar to everything else, year over year, the IRS does adjust it according to inflation. So if you offer a plan that's a high deductible health plan, in order for it to be HSA qualified, usually 100% of the expenses up to that amount, so let's say it's that, $1,400 or the $750, has to go towards the deductible. That means right now, many of us are used to a standard health insurance plan. So when we go to the doctor and it's not for preventative care, maybe we have a cold or we have a tickle in our throat, we're not really sure what's going on. We pay a copay when we go there. Maybe it's $20, maybe it's $40, whatever it may be, depending on your plan. You're paying a copay. When you have an HSA plan, you're paying the full cost of that visit, which is usually significantly higher than that $20 or $40 copay. We're normally looking at anywhere between a $200 and $300 doctor's visit. So that's the first thing there is to think about, is the high deductible health plans that are HSA compatible. Everything is going towards that high deductible cost. So there's no real co-insurance, there's no real copays. Sometimes certain carriers will build in a co-insurance or a copay for very limited reasons, like a hospital visit, or an ambulance ride or urgent care, because they're trying to encourage you to do one thing versus something else. But on average, when you look at your plan benefits and you're in an HSA compatible high deductible health plan, everything will say deductible, 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 deductible next to all the items on the left. Where if you look at your general insurance now and you're not on that kind of a plan, it'll say $40 copay, $80 copay, 20% co-insurance, 30% co-insurance. So that is a big varying differential there. So the first thing to realize is it needs to have a high deductible health plan to pair itself with. So not everybody can have a health savings account. It's best sometimes, depending on what your deductible is, for people with a low healthcare expenses. So these are people, for example, who have very limited healthcare year-over-year usage. They just go for their preventative care. They're not on long-standing maintenance medications. They don't have any kind of generally underlying pre-medical condition that requires them to see a doctor ever so often. Usually it's families, It's families, I say, that don't have children. And sometimes that's just because if you have children, you realize they get sniffles more often. If you have children in sports, they get injured more often. And so that high deductible cost out of pocket can be significant for families. Not to say that it's not a good choice, however. I will say, for example, I have a family, myself, my husband, my child, we're on a high deductible plan. The perk often in insurance companies when you're working with your employer is high deductible health plans that are HSA compatible usually have very low or significantly lower premiums out of pocket. So that means that if you had, for example, a $3,000 standard health insurance plan that has your co-pays and your co-insurance and your RX, which is your pharmacy or prescription deductible, usually you're paying, let's pretend for paycheck, you're paying, and I'm going to ball it to where I've kind of seen it lately, $100 per paycheck if you're weekly, to anywhere between 100 to 150 biweekly for an individual. While when you have the same plan, let's pretend that's high deductible, a $3,000 high deductible health plan with everything towards the premium could be $60 every week versus 100 because the premium is lower. And the reason for that is health insurance companies assume that when you have to pay everything out of pocket first, you will be a more conscientious consumer. So they expect you to pay attention. Are you going to the lowest cost providers? Are you paying attention to what your doctor is saying? Are you trying to make good choices? Or are you one of those people that every time you have a cough, instead of scheduling a doctor's appointment, you're going to the ER? So there's different utilization here. So that's how those plans work. The premiums are lower, which is what's great for an employer because they think to themselves, the premium's lower if I'm covering 80% of the premium for my employees. Now the premium is lower. I'm able to, offer these other plans, health savings, health reimbursements. The other great thing about the health savings account is contributions and withdrawals our interest are all tax-free. So I can put into out of my paycheck the difference. So if I'm paying a $70 premium out of my insurance, it would have been $100 if I picked the other plan. I take $30 out of my paycheck and I put it into my health savings account to help what I like to call fund my what ifs, to fund that $3,000 if I get injured and I need to go pay for something. Health savings accounts you can enroll in at any time if you have a high deductible health plan generally. So it is one of those plans that you can change as you go. My mom, for example, is on a high deductible health plan. She has an HSA. And when she was fully funded, because she had several years of really great health, her HSA was full. So if she got injured or sick or something, she had the full $5,000 is what they were utilizing. She had the full $5,000 in there to be able to cut a check or swipe for her card to pay for those expenses. So we stopped paying into the account because I said, you've got where you need to be. You're not utilizing it for investment, which we will talk about in a little bit. So you're good to go. You don't need to keep contributing. So now she's double winning because she's protected if something happens, and she's gaining on that pre-tax lower premium for payroll. Who is eligible? We went over employees with high deductible health plans. You cannot be enrolled in Medicare to be on this plan. And then you cannot be claimed as a dependent. So if, like my daughter, well, she's one, so she wouldn't be able to be doing these things anyway, but she would not be able to open up her own health savings account. She's my dependent. I have her on my taxes like that. So you can't, the IRS does have its own parameters to prevent families from kind of double dipping or to have certain people who are maybe high earners use it as like a really crazy tax shelter. The IRS is not that stupid, so they're not trying to, really be worried about that kind of stuff. So if you're being claimed as a dependent, you're on your parents' insurance, you cannot open an HSA account. Who owns the account? It's you, the employee. So when we talk about these three different plans and who owns them, health savings are your money, your dollars, so your tax reporting requirements. Some people are like, Toni, you just said that the taxes, there are no taxes. You're right, I did say that, and I'm sticking to it. But when you file for your taxes, they say, hey, have you contributed to an HSA this year? And you can say, yes, I contributed $2,000, $3,000, that's your tax break. You got the tax break on the payroll, but they want to make sure that they're recording it on their end. So it's your responsibility. Usually you get something in the mail from your health savings, whoever's managing your health savings arrangement, or health savings account. So it's like a 1099-R. Definitely work with your accountant or your tax professional to get that information if you're not sure. But it is owned by you. So what does that mean? That means that if you are working for an organization and they have a health plan and that is HSA qualified, you want to put money into it, look at you go, you're doing great, you put $2,000 in, and then maybe you get another job offer, or unfortunately there was a layoff, so you don't have that job anymore. That money goes with you. It doesn't stay with the company. It's your money. It stays in that account. Now, there are very specific reasons you can use it, but it's still yours, which means it's not a lose it situation. It's not, okay, Toni, well, I haven't spent it by December 31st, so all of it is gone. It's a savings account. It lives forever. You could be putting that money in there until retirement. Like, you really can just continue as long as you're on a health savings compatible plan. You could continue to put that money in there. There is no threshold for what the account can hold, just how much you're allowed to put in every single year. So that's something to pay attention to. That's really, really great. Who can contribute to the health savings account? This is the fun part. Anybody, in the sense of, it can be you, the employee, it can be you, the employer, or even employees' family members. So it's fantastic. So if the employer says, okay, we're saving on the premium, I'm going to help contribute to the health savings account because I want the employee to know that we know that there are things that pop up. We know that there is care and coverage that they're going to need to spend out of pocket. We want to be conscientious of that. And we're going to put some money in there to help alleviate some of that cost. Fantastic. You, the employee, can put it in. Do you have to? Absolutely not. Your family members can contribute. Now, I will say, when your family members generally contribute, they probably don't work at the same company as you. So when they contribute, their dollars initially are going to be considered post-tax dollars put in. But when you get that 1099-R, I'm pretty sure is what it's called, it'll tell you how many pre-tax and post-tax dollars, so you can take that deduction on the back end during tax time. So again, still a fantastic benefit. Still, you're going to get the pre-tax earnings, whether it's in the beginning or in the end. When you contribute and you're on a health savings account, you cannot contribute if you have a flex spending account. Now, when we get to the flex spending, I will say there is a caveat here. There is something called a limited flex spending account, FSA. You can be in that. What that means is, if you are on an HSA plan, remember, and we have an HSA account we're contributing to, that money gets used, medical, dental, vision, totally up to you. If you want to be on a limited flex spending account, you can be. You just have to use those funds for only dental and vision. So whatever you put in there is only dental and vision, and everything else you're focusing on for your HSA account is medical if you want. So there are a few ways to kind of pair things in a unique way. How much can you contribute each year? So for an individual, for 2022, you could have contributed, and still can, quite honestly, you could do lump sum contributions. You could contribute $3,650 if you're an individual. And then if you're anything other than individual plus one, individual plus child plus spouse, full family, you can contribute $7,300 for the year. You and your spouse cannot have their own HSAs and each of you contribute $7,300. You can each have your own HSAs. You can each contribute to them, but together they still can only equal $7,300 if you're on a family and you're doing your taxes together. For 2023, they've already given us an update that they're going to use moving forward. So we see, to $3,850 for an individual and $7,750 for families. So they do take into account usually year over year some inflation. This is one of the largest jumps I've seen, to be very honest. Normally we see $25 to $50 a year increase over time. So this $200 on the left for an individual contribution is pretty significant. What can you do with these expenses that you've put aside? Qualified medical expenses outlined by the IRS. There are a million things to buy. Some people are like, well, what's qualified? Your prescriptions, your co-pays, your co-insurance, your doctor's visits. If now they've allowed other kinds of things, for example, feminine hygiene products. There are certain vitamins that you're allowed to have. There are other kinds of Band-Aids if you want durable equipment. So, I think about during COVID, a lot of people with the blood ox, they had like the little ones that you put on your finger, the most common. You can buy those at Walmart. Well, you could buy that under your HSA if you really want to. You could buy a stethoscope, you could buy a blood pressure test. So there's all sorts of stuff that you can utilize. You can start your own basically medical supply kit inside of your kitchen. So there's all sorts of stuff that is qualified and it's under the IRS. They have to be expenses that are incurred by you, the employee, or your dependents. So again, even if your child isn't necessarily on your plan, maybe they're on the spouse's plan, you can use those costs to cover if your child got injured or has to go to the doctor. But it does not include your health insurance premiums. So you can't use your HSA money to pay for the premiums that are coming out of your payroll. So it's not like double dipping your pre-tax premium and your pre-tax HSA and you're reimbursing yourself for that. Additionally, you can utilize it to pay for example, if you're on the exchange, if you're on like the health insurance exchange through your state and you're paying directly, and you've decided to be on an HSA and you open up an HSA with your local bank, you wouldn't be able to say, okay, I'm going to reimburse myself for all the money that's come out of my pocket this year for premiums. So premiums are not qualified. Would not be nice. Here's a weird question. Can you invest the money? It depends on your HSA administrator. So we work with several administrators that the answer is yes. So once you've hit a certain threshold, the threshold is usually defined by the IRS and or the company, you can put the rest of your money that you're putting into there into the stock market to incur some additional things. So it's like a secondary savings account for retirement, if that is how you want to utilize it. So again, it's a huge benefit for those pre-tax dollars. So usually there's a threshold. For example, I've seen it at one organization, it's $2,000. So once you put $2,000, you don't have to, but once you put $2,000 in, let's say you accrued another $1,000 in payroll that you would put in there, you could say, okay, I want that extra $1,000 to go towards the stock market. I want to see how it does. And I want to earn, interest on that, and it compounds interest and all the kind of magic that happens during a retirement account. The HSA account can do the same thing. So it is nice that you can contribute to that as a retirement account if you don't have a lot of health expenses and maybe you've already maxed out your 401k or your retirement account. So it's really, really helpful there. If they do, like I said, the account typically must reach a certain balance before funds can be invested. They usually don't let you invest the first dollar. They want you to have some kind of bucket in there to utilize in case of a medical emergency. But then usually they can. If you're doing it through your direct bank, sometimes the banks don't have the capacity or the platform in order to do that. Sometimes the banks do. So it's absolutely a question if you're going directly through your bank to ask that question. And again, it's tax-free investing. So it's fantastic. It's like a pre-tax 401k or a simple IRA, whatever you're kind of investing in currently. So really great options. Rollover and portability. Do funds carry over from year to year? Yes, 100% of your funds are yours and they carry over year to year. This is not a use it account. This is not, I haven't spent $1,000 on medical expenses, now it's going to disappear. The money grows. That's why they call it a savings account, because its intent is to grow. Is the account arrangement portable after termination? Yes, it goes with you. It's another huge perk. The other plans that we're going to describe, I'll explain pretty clearly on how they work for termination as well. But the HSA goes with you. So all the money you contributed, and if you're lucky enough to have an employer who contributes, and you're lucky enough maybe to invest some of those funds and accrue those interests, you're able to take it with you. Now, if you go to another company that doesn't offer a health savings, high deductible health plan account, you cannot continue to contribute, but you can leave the account as is. You can use these funds also if you needed to, hopefully you wouldn't, but if you needed to cover COBRA premiums. So they did put that in a couple of years ago. They allowed that very tight caveat. So I know I said it doesn't count for premiums on your standard side, but if you had to COBRA because you lost your job, there are some caveats there that the IRS did recently put into play. And remember, the IRS changes these plans sometimes yearly, so something that might have once been might not be anymore. But that is something that they did allow currently. So the money is owned by you, the employee, whether you're terminated, whether you switch to a different plan, whether you voluntarily resign. So you get to take all those funds with you. They may force you to roll them out of where they're being housed and put them into a health savings account bank that takes the money. So then you own the account individually, but the employer will not be able to keep any of those funds. Unlike a 401k that requires certain vesting, when employers put their money into your HSA account, vested day one. Okay. So that is our HSAs. So HSAs are fantastic. There are a million reasons to use them. I love them. I have been on one for 5 years now. I have my mom on an HSA account. If you leverage them appropriately and accordingly, they can be huge dollar savings. And even though it seems risky, if you do it smartly, you can reduce that risk pretty quickly by paying attention. So it's awesome. The other thing, like I said, is you can do kind of those lump sum contributions. So my mom, for example, if she started using her funds and realized she used some and then she has more medical expenses, well, at the year end, she could say, okay, I'm going to put $1,000 in versus 1,000 divided by the 26 payrolls, and you can still get that pre-tax benefit. Remind everyone, if you have any questions, feel free to shoot them into the chat box. I have no problem answering them. After the fact, obviously, when you get my email, if you had an individual question, you'd be able to email me directly and I could get those answers to you as well. The next is a health reimbursement arrangement, or HRA. Again, I've heard these be called health reimbursement accounts. I prefer to call them arrangements, and the reason for that is you'll see how they're generally designed is unlike a health savings account. It's not necessarily an account that stays in place no matter what. It's more of an arrangement that's designed with your health insurance plan. Very similar to the health savings account, it is used for health insurance expenses. Some companies can even set up HRAs for dental and vision expenses or for prescription. You can do all sorts of different stuff with HRAs, but it's generally aligned with deductibles for health insurance. It is a pool of money funded by your employer. Employees are reimbursed generally after the fact, and there are multiple ways to utilize it. So what do you mean, Toni? Multiple ways. Okay. Let's say that you have a $2,000 deductible. All right. Well, I've seen plans that look, for example, like this. You may have to pay for the first $250 of your deductible when you have to go to the doctor all that time. But then the $251, that first dollar and moving all the way up to $2,000 could be reimbursed to you through the health reimbursement arrangement from your employer. It could be reimbursed many different ways. I have seen employers who do something called a file fee, which means your insurance carrier gets all the information for the claims, sends it over to your to whoever's managing your health reimbursement arrangement, and they can either pay directly to the employee or they can pay directly to the provider. I personally never, ever, ever, ever suggest paying the provider, ever, for multiple reasons. One, payments get lost. Two, it doesn't necessarily make your employees very conscientious consumers. Three, oftentimes, very, very often, I see employees pay the bill and then we've paid the bill, and then trying to get that money back from the provider is basically like trying to pull teeth. You are almost never going to get it back, or it's going to take you so much time and headache. So if you do have an HRA and you do have what's called PTP, or pay the provider, I encourage you to transition away from that, quite honestly. But you generally pay the employee. So that's what's called an employee pays first plan. I've seen some plans that are designed where the employer pays first. It's all about culture, dollars, and what your health insurance plan looks like. So for example, you could say the employer is going to pay the first $250 of that deductible. And then the employee is going to pay every dollar after that up till the $2,000 mark. That's an employer pays first. There's something called donut HRAs, which means it's a back and forth. So you could say the employee is going to pay $250, and then I'll pay $250, and then you'll pay $250. I don't love those plans. I think they can get very complicated and confusing for employees. I generally go with an employee pays first, and then you get reimbursed, because you still want employees to be paying attention to have skin in the game, paying attention to the cost of insurance. Because year over year, if they're not paying attention to that cost, your insurance is going to increase year over year, making these plans even more important to leverage so that you can really be paying attention. The great part about the HRAs is they work really well with those high deductible health plans as well. So if you have a regular plan that's not HSA compatible, let's say you have a $5,000 deductible for your employees. That's a huge deductible. And a lot of people get freaked out. And some people are like, this is a terrible plan, $5,000, that's crazy. Well, what if you said the first $2,000 is your responsibility, essentially making it a $2,000 deductible plan for the employee. The last $3,000 I'll cover as the employer. You're getting two great things. You're gaining the fact that one, you're generally getting a lower premium, similar to the health savings accounts I was telling you about, how to be with high deductible. The annual premium on those are much lower on the high deductible plans for HRAs. And you only have to pay for people who need it. So instead of having like a flat expense for an HSA contribution where everybody on the plan gets, the $200 or the $1,000, whatever, the HRA only pays for people who utilize and need to be reimbursed. So it helps you stay a little bit more in tune with what's going on with your insurance plan. It helps you save some of those dollars because you can say, okay, Toni, that's really scary. We have 30 employees and $3,000 for each employee would be crazy, Well, it's not $3,000 per employee. The chances of each employee hitting that HRA deductible and utilizing the whole amount is very slim. And there's statistics depending on who you go to that can provide you, these vendors who provide you this data can say for a company your size, people on this plan, people in this age group, this is usually what we see for utilization. And you get to pull those reports. So a health reimbursement account is fantastic. If you want to have a higher premium on a more standard plan, that's a little less scary maybe than the health savings account plans. You want to get a low premium on your insurance as the employer to help reduce those out-of-pocket, payroll deductions for you and for the employee. But you want to give them a little bit more comfort by knowing, yes, this is a high deductible plan with $5,000, but you only have to worry about the first $2,000, and then we'll help you cover the rest. So it's really great. There's a lot of things to choose from here. Who is eligible? Some plans require health insurance. So what that means is some employers will say we have a health reimbursement arrangement and you have to be on our health insurance plan. Some employers can say we have a health reimbursement arrangement and we don't care whose plan you are on, we'll reimburse you for a certain dollar amount. So there are different designs here. Health reimbursement arrangements can get really, really, really complicated, but still be very heavily utilized. So there's so many opportunities for you to pair these. And that's why I always suggest speaking with either myself, one of my team members, or somebody who specializes in those benefits to work with your TPA, third-party administrator of these plans to help build what's perfect for you and your organization, your industry, and your culture. Employers get to decide who is eligible. So, unlike the HSA where employees get to put their money in on their own, employees do not get to put money in an HRA plan. So employers get to sign, is it full-time, is it part-time, and how much I'm going to contribute, and what is my offering going to be. The employer owns this account. So if at the year end, the employees haven't utilized any of their funds, the employer gets to say, we'll roll the funds or we're not going to roll the funds. Next year, we'll start off square one. You'll be in charge of the first 2,000 and we'll be in charge of the next 3. Or they can say maybe $500 of unused rolls over. There's, again, so many different ways that you can do it. But it's owned by the employer, which means if the employee leaves and the employer said we would have contributed $3,000 if you had used it, you don't get to take the $3,000 with you. It stays with the employer. It's employer owned. There is no tax reporting requirements for you as the employee, which means when you get reimbursed, there's nothing you need to do. There's no tax documentation. It's just essentially free money from the employer to you to help cover those costs that you've already incurred and spent on. So it's great as an employer to be able to offer that benefit to the employee with no tax implications. The employer gets to take a tax deduction himself, which is fine. So who can contribute? Employers only. As I said, your employees cannot contribute. Contributions are tax-free. So on the employer side, you get to take a tax deduction on whatever you paid for employee deductions. And employers can claim a tax deduction on reimbursement. So like I said, how much can be contributed each year? So this varies based on plan. Obviously, if you have a $5,000 plan, you can't contribute more than 5. But it also sometimes varies on the carrier and the state. So for example, we had seen a while back where Blue Cross Blue Shield in Massachusetts said you could not fund a health reimbursement arrangement more than 50% of the deductible. They wanted employees to have skin in the game. They wanted to be very specific to them. So they said, this is any plans with us that are HRA qualified cannot have more than a 50% reimbursement. Some carriers get to make that choice. A QSE HRA is for small employers. There are limits depending on that. So an individual could only receive $5,450, family $1,150 in 2023. It goes up, as you can see as well. If your next question is, can I pair a health reimbursement arrangement with a health savings account? You're darn right you can. Double tax winnings. Now, there are certain requirements that an employee has to pay on the employee side of the HSA before you, the employer, can do any kind of reimbursement. I believe it's like $1,350 for an individual. So that means that they have to pay out of their own pocket a minimum of $1,350 before you can start putting reimbursing them on their HRA. So there are requirements. And there's no required contribution limits. So if you only wanted to reimburse somebody $200 or $2,000, you get to make that election and selection. What is eligible? Excuse me. Qualified medical expenses, very similar to the first one, usually generally just deductible, but as I said, you get to pick. You could say if it's a dental reimbursement arrangement, you could say if it's a vision, you could say we're willing to take any medical, dental, or vision whatsoever, we don't mind. Usually these plans are required to see an explanation of benefits showing that the plan has been paid before it gets reimbursement. Some plans permit otherwise, in which case funds must be included as income. Very specific plans, when you're working with your TPA, again, your third-party administrator for these benefits, they will tell you which ones to be conscientious and cautious of. Very few do I see move in that direction, but they are allowing you to get more and more unique and more flexible with some of these HRA designs. So that's great. What is the investment? Nothing. Funds are employer owned and only eligible for healthcare reimbursement when it's used. So it's not like you need to necessarily, be conscientious, but it's not like you need to necessarily, as I gave the example, you got 30 people on your benefits and you want to do a $3,000 reimbursement. It's not like you need to have a bank account with all that money in it as of day one of opening the plan. You only have to pay attention when people are utilizing the plan and then the dollars here and there after the fact. And once you have started an HRA, after you've had it for a year, you have really great reporting. So you'll see how many people used it, usually not the names. Obviously, certain things are very HIPAA protected, but you'll usually see, okay, you had 4 employees who utilized it. And out of those 4, maybe only 2 utilized the full 3,000, the other 2 utilized 400. So it does show you the utilization data, not the utilization person, of course, because we're trying to protect still private health information. So the great thing is it's only used when needed. So unlike having a really, really low deductible for your employees with a really, really high premium, because you're like, oh, well, I want to offer the best benefits, not realizing maybe you have employees that are real healthy and don't need to worry about that, you can offer a higher deductible with lower premiums and fill that gap, which is what an HRA to me is. It's a little bit of a gap filler. So it helps you do that. Do funds carry over to the next year? This is one of those things you get to select. You get to decide yes or no. So if Toni hasn't used the $3,000 that was available to her, we're going to let $2,000 roll over. She has a $5,000 plan. So now she's eligible for her full amount. Fantastic. Or you say, no, we don't want to roll plans. Every single year, as I said earlier, we're going to start from scratch. That is up to you. Or you can put a particular limit into it. You can say up to $500 or $250. Whatever it is, you're allowed a lot of flexibility when designing the HRA plans. Is the account or arrangement portable after termination? So generally the answer is no. It goes back to the employer, right? As I said, you don't get to take the money with you. However, HRAs are something that are COBRA eligible. So you could COBRA your HRA. There generally is a cost for the employee to continue to maintain the HRA access, but they could COBRA that specific piece. So COBRA is something, obviously, remember that is continued benefits if somebody were to terminate or if there's a major life change event, loss of insurance, where they pay 100 to up to 102% of the premium of their medical, dental, vision, or anything else that is considered portable. an HRA would be something that would be eligible to be portable, but you could require the employee to pay in order for them to utilize it. So here's our beautiful HRA heroes. So as I said, HRAs help soften the blow from expenses. The plan is to fill in the gap so that employees are like, a $2,000 deductible I'm used to. $5,000 is very scary for me if I'm a family. I have children, and a $5,000 deductible is usually only on an individual, so now it's 10. You know, so it's paying attention to that and letting them know we're softening the blow. We're covering some of these back end expenses if you have them, but if you don't have them, don't worry about them. We're your safety net. Next, we have flexible spending accounts, or FSAs. These are probably the most commonly known. As I said, there are generally two. There's the flex spending or the limited flex spending, which is eligible for HSAs only. Flex spending accounts are also IRS defined healthcare expense accounts. They can be used for medical, dental, vision, and it is generally considered a use it or lose it account. The employee does not, if you have health insurance and your company and the employee doesn't enroll in health insurance, they can still enroll in the flex spending account because maybe they have health insurance somewhere else. Maybe they don't have health insurance, but they want to be able to be covered under the flex spending account. So it works best for people who have very predictable expenses, prescriptions, annual things that they need to go or do, contact lenses, glasses. If they know that they have certain dental care, predictable things that the employee can kind of pay attention to. Who is eligible and the ownership? Who's eligible? Employees. There's generally no plan requirement, like I said. Employers can decide a minimum and a maximum enrollment dollar amount. So the IRS has certain maximums right now for 2022. It's $2,850. Employers sometimes don't like that full amount, and I'll explain why in a minute. So sometimes they'll say, okay, well, we only want employees to be able to put $1,000 in. So you as an employer could limit internally what the max amount would be for an FSA. The employers own the account, but this is a little unique. So no tax reporting is required, but it is pre-tax, which means when employees contribute to it, it's on a pre-tax basis. FSAs work really interesting when it comes to contributions. FSAs can have both employees and employer contributions. I very rarely see employers contributing to a flex spending account. Mostly I see employees. As I said, these are the $2 amounts. However, this is how those work. At the beginning of a plan year, an employee can select something. Let's say for round numbers, because I go bi-weekly, that we elect $2,600 into our flex spending account. Well, every single pay period, I put $100 in because I'm bi-weekly. Well, as of day one of me enrolling in that plan, all $2,600 are available to me to utilize day one, even though I haven't put $2,600 in there. So this is why FSAs sometimes are considered a little riskier, because an employee technically could utilize all the funds before they pay their payroll premiums. And they technically could separate either voluntarily or involuntarily from the company, and the company has no way of recouping those costs. It works in reverse. An employee could spend an entire year contributing $2,600 to a plan, never utilize a dollar, and then is terminated or leaves. All those dollars stays with the employer. There's very specific things you can do with those dollars. You can't just like take them and go on a trip, but it does stay with the employer. So it goes both ways. I will tell you, I worked for a TPA company for 6 years. Very, very, very rarely are companies getting, forgive my language, screwed over on this, quite honestly. Yes, maybe it happens here or there, but it works in the reverse just the same for the same kind of companies. I have not seen anyone lose their shirt essentially on flex spending accounts because all these employees were spending the money and then leaving. So it's not necessarily it gets a bad rap because all the money is available first, but that's very, very, very rarely, not never, but very rarely is that something that is really being abused. Okay. Eligible expenses, qualified medical expenses as defined by the IRS. It does not include insurance premiums. And is there investment? No, we can't invest our money from a flexible spending account. But again, we can use it for any qualified medical, dental, or vision expense. I like to go to a website called FSAstore.com. That is always in compliance. So you could go on FSAstore.com and see everything under the sun that is eligible under a flex spending account. There's also HSA sections on that website that explain what's HSA qualified. Not to short FSAstore.com, they're a fantastic resource. Sometimes the cost of things on FSAstore.com are a little bit more premium cost, but it gives you a great idea of looking on there and seeing, and then you could purchase those things from Walmart, from Market Basket, or Amazon, wherever you feel like shopping. But at least that gives you a full list and a good idea of what would be eligible under flex spending accounts. So some people don't even realize that sunscreen is covered under a flex spending account. There's all sorts of other stuff, health related wise, that you could use. And when people think to themselves, oh, I don't need an FSA, if you spent even $1 in the last 12 months almost, right? We're coming into December soon. If you spent $1 out of health, medical, dental, vision, you should have been in an FSA if it was eligible, because you're saving on average 30% tax savings on the HSA and the FSA when it comes to dollars spent. When you're spending it post-tax, you're spending that one hard-earned dollar. When you're spending it pre-tax, you've given yourself a 30-cent raise. So it's really, really fantastic to utilize and leverage these plans. Next is rollover and portability. Do funds carry over year to year? Generally, they don't. So this is the use it or lose it part of the plan. However, the IRS has made them a little bit easier. So what the IRS has offered is a rollover, which is usually $500. So they'll say, okay, if you have $500 or less, we'll roll it over from year to year. Or you can't have both. So this is either or a grace period, which means, let's say you're January to December for your plan year, for your calendar year, all your stuff. December 31st comes, your employee hasn't used their funds. Usually they give a 90-day grace period, meaning that for the next 90 days, all the way through March, you can still incur expenses, you can still use your funds, and we're not going to penalize you, use it or lose it. So those are two really nice ways that the government has said, listen, we realize use it or lose it is a little harsh for those pre-tax funds. This is what we're going to do to help alleviate some of that confusion and cost. So personally, I'm a larger fan of the $500 rollover. And the reason for that is this: if I have an employee who is skeptical about using their account, I tell them to only enroll in $500, because I say, listen, there's no risk. You're risk-free here. So out of the $500, if you use nothing, 500 will roll over and you can use it next year. And if you use it, awesome. Still, whatever you haven't used is going to roll over, or you can re-elect more money next year. So I prefer the $500 rollover. Some people like the 90 days extra to spend the funds. It's totally up to your culture. That's just my preference. Is the account arrangement portable after termination? Again, it's a no. This is a no. Unused funds are forfeited. So this is one of those things that people are bummed about. I will say this: if an employee terminates, let's say an employee terminates today, right? So they terminate on November 10th, but they did incur expenses before November 10th, and they have money in their account. They generally do have, I think it's like a 2.5-month timeline to continue to submit receipts during the time they were eligible. So they can't continue to get costs on there. But if they're like, oh, well, I never submitted a receipt for my blood work, or my daughter's new glasses, or my son's cavity filling, they would be able to go back and submit for those because they would have put the money in and they would have been able to get the expense. But generally, other than that, it's not like they can take it with them and move it from one place to another. So as I was saying, this is just a home screen of the FSA store. So as you can see, there's all sorts of cool things that you can buy that's FSA eligible. I mean, we have some skin clear, we have some first aid kit, we have a special weight thing, we have some Superloop, which is sunscreen, 23andMe. There's all sorts of great things here. So if you're like, I'm not really sure what's even FSA eligible, more and more things are being added under the IRS on a regular basis. So if you're ever in doubt, FSAstore.com has the knowledge for you to be able to drop in there and figure that out. How do you choose the right supplemental health insurance account for your business? Great question. As I said, all three of these things can work together and work in tandem. So you could have, for example, a health savings account with a health reimbursement arrangement and a limited flex spending account. You could have a health reimbursement arrangement with a flex spending account. All of these things pair really, really well together. And the reason is because it's both a mixture between employee and employer, helping and taking a little bit of the onus of some of those costs and expenses when it comes to health, medical, and dental and vision. So the first thing is it does depend on the health insurance offered. But as we're heading into renewal, I know maybe most of us have already made our decisions, but if we're maybe not a January 1st renewal, I would say look at those plans. And if you're thinking to yourself, that premium has gone up significantly, ask your broker, you know what, I'd like to see some high deductible premiums, health insurance plans, and then let's talk about a health reimbursement arrangement. Let's see what our cost savings would be on those premiums, and then see if we can back ourselves into a health reimbursement arrangement. It also depends on how much you can invest. So I would say if you're a company that's like, excuse me, we have a lot of extra money, we've already maybe done a 401k, whatever it may be, you can say, all right, we have X, Y, and Z dollars, we'll contribute to everyone's HSA. So remember, HSA is money right away though. So some employers like to do the HRA versus the HSA. Flex spending accounts, I generally, like I said, do not see employers contributing to them. Not to say they don't, I just generally don't see it as a general practice, but offering it for employees to utilize is huge. When in doubt, don't be afraid to ask your employees if they think something would be good. Is a health savings account something you'd be interested in? More and more employees have come or have worked in places that have those. Would you utilize flex spending account if we don't have it? Oftentimes with a flex spending account, which we didn't talk about today, comes the dependent care account, which is money that they can set aside pre-tax for childcare expenses. It works a little different than the FSA in the sense that, unlike the FSA, where, as I said, all your money's there day one, whether you've put it in or not, that is not how a dependent care works. Dependent care is the money's only there when you've put it there. So it's paying attention to that. But again, it's pre-tax dollars. And in a time where inflation is, I believe, between 7 and 8%, it is a great time to think to yourself, how can I get a little bit more creative? How can I leverage my resources to help bring still very, very comparable and competitive benefits to my employees without having to come at them for cost for things? So paying attention to that. I know I just data dumped on you guys so much information. I hope you can tell how passionate I am about these three things. I love benefits. I know it is the bane sometimes of my existence, but when I can look at a benefit plan and I can evaluate and say, okay, here's what we're going to do. We're going to increase this premium. We're going to increase this deductible, decrease the premium, pair an HRA, give the employee a better benefit, reduce the employer's cost. I get jazzed. So if you have questions, please do not hesitate to contact us. Please do not hesitate to contact your broker. They are very informed as of these plans. And I will go as far as to say, if your broker does not know what I am talking about today, please contact me and I'll get you a new broker because your health insurance broker should be up and up on how these plans work, to be always looking for the most competitive plans for you. Health insurance is one of our biggest costs next to payroll when it comes to businesses. And any way that we can pay attention to the costing while still offering really, really solid plans and coverage to our employees, we definitely want to do that. If you are trying to contact us, please feel free to do so through our email here. Stay up with us on our social. We offer these great trainings every single month, specialized on all sorts of different things. We just are nailing down our 2023 data. So if you are following us or you get our newsletter, you will get that pretty soon, letting you know what our 2023 schedule of events looks like. So please follow us. We love to give information for free. These are things that we know employers need to know to help run really solid and great benefits and businesses. So free is something for me, and we love doing it for our customers, for our partners, and people that we work with. Okay, there are no questions in the queue. So I appreciate everybody attending today, and I will be sending this presentation out. Thank you so much and have a fantastic day.